Imagine waking up one morning to learn that every single person on your street was deep in debt. The butcher, the baker, even the banker, all of them owed staggering sums of money. Your first question would be simple. Who lent them all this money? Who holds the other side of those IOUs? Now expand that question to the entire globe. We are told that global public debt has reached an almost incomprehensible $97 trillion. That number is so vast it becomes meaningless, a blur of zeros. We feel its weight in the form of austerity measures, in the constant pressure of inflation eating away at our savings, in the political instability that seems to grip nation after nation. The human cost is very real. But the mystery remains. If nearly every government is a debtor, who or what is the ultimate creditor? The answer defies our basic understanding of lending. This isn't a case of money being transferred from a saver to a borrower. This is something else entirely. The money isn't owed to a person or even a country. It is the essential, volatile fuel of a system that has learned to feed on itself. To understand this, we need to trace a historical shift, a quiet revolution in how power is financed, that turned national debt from a simple obligation into a complex, self-sustaining machine. Central banks. The most significant creditor in the modern debt universe is also the most misunderstood. It isn't a foreign power or a cabal of bankers. It is a ghost in the machine, the central bank. This relationship is the cornerstone of the entire $97 trillion paradox. The mechanism is called Quantitative Easing, or QE, and its logic is perfectly circular. A government, needing to spend more than it collects in taxes, issues bonds, essentially formal IOUs that promise to pay back the borrowed money with interest. In a traditional system, those bonds would be sold to private investors. But in our system, the central bank steps in. It creates new money digitally out of thin air and uses it to buy those bonds from the government. The government gets its money and the central bank gets an IOU from the government. The debt is now an asset on the central bank's balance sheet. The government owes the money to itself. This wasn't always the case. The Bank of England, founded in 1694, began as a private institution lending to the state to fund a war. It was a straightforward transaction, but over centuries it evolved into an arm of the state itself. The real explosion, however, came after the 2008 financial crisis. Government debt ballooned from under $1 trillion to over $4 trillion. It did the same again during the COVID-19 pandemic, pushing it to nearly $9 trillion. This debt is not held with a profit motive. The Federal Reserve is not a speculator, it is a stabilizer. Its goal is to keep the system liquid, to control interest rates, and to manage the economy. Treasury. The debt in this closed loop is a policy tool. It is not meant to be repaid in any traditional sense. Repaying it would mean the Fed selling those bonds back into the market, which would crush their price, spike interest rates, and likely trigger a deep recession. So the debt remains a permanent fixture, an illusion of an obligation that serves to grease the wheels of the entire financial system. The first and largest creditor, therefore, is a non-human entity with no desire to be made whole, pension and sovereign funds. But central banks don't hold all the debt. A massive portion is owned by another class of seemingly powerful but ultimately captive creditors, pension funds and sovereign wealth funds. These entities are not buying debt out of choice. They are buying it out of necessity, forced by the very architecture of the global financial system. Consider the trillions of dollars managed by pension funds for your retirement. Their primary mandate is not high returns, it is capital preservation. And for the last half-century, government bonds have been designated the safest asset class in the world. This status is reinforced by a web of international banking regulations, like the Basel Accords, which incentivize, and sometimes mandate, that financial institutions hold government debt. These funds are not active investors, they are permanent buyers. The case of Japan is the ultimate example. The Japanese government has a debt-to-GDP ratio of over 250%, the highest in the developed world. Who holds this mountain of debt? Over half is held by the Bank of Japan, following the QE model, but a huge portion is held by Japanese pension funds, like the Government Pension Investment Fund, GPIF, the largest of its kind. They are essentially propping up their own government's borrowing. It's a closed, self-reinforcing loop. The sovereign wealth funds of oil-rich nations play a similar role. They recycle petrodollars, revenue from oil sales, into the government bonds of Western nations, primarily the United States, seeking a stable place to park their enormous wealth. This creates an inherent and dangerous conflict. The security of your retirement, the stability of entire national savings pools, is inextricably linked to the perpetual expansion of government debt. These funds are so large that they cannot simply sell their bond holdings. Treasuries or German bunds, it would trigger a market collapse, destroying the value of its own portfolio. They are trapped. They must keep buying to maintain the illusion of stability, making them not powerful creditors, but vital cogs in the machine. Their demand is not voluntary, it is systemic, ensuring there is always a buyer for the next $1 trillion of debt. Foreign governments and geopolitics. While central banks and pension funds are captive to the system, the third major holder of debt operates on a different plane entirely: foreign governments. This is where the debt takes on the character of a high-stakes geopolitical chess game. Treasury bonds. For years, China accumulated trillions of dollars in reserves from its trade surplus with the United States. Debt, not merely as an investment, but as a deliberate tool of economic statecraft. This relationship creates a mutual dependency that is both stabilizing and deeply fragile. America gets a seemingly endless line of credit to fund its deficits, while China gains leverage and a stake in the stability of the global economic order it depends on for its exports. This dynamic is underpinned by a system born in the 1970s, the Petrodollar. Struck a deal with Saudi Arabia. Dollars. Currency. S can issue debt in its own currency, which it can also print. It is a unique advantage no other nation possesses to the same degree. But this weapon can be turned around. Debt ownership becomes a form of leverage. In a diplomatic dispute, a country can threaten to dump its holdings of another nation's bonds, potentially driving up its borrowing costs and destabilizing its currency. China relationship. What happens when your largest foreign creditor is also your primary strategic rival? Yet, even this geopolitical tension serves the system's ultimate goal. Debt is the focal point of international power struggles, reinforces its status as the indispensable global reserve asset. The demand from foreign governments, whether friendly or adversarial, is not about getting paid back in full. It is about maintaining a seat at the table and ensuring the system from which they derive their own power continues to function. Their ownership is not that of a traditional lender awaiting repayment, but of a player using debt as a chip in an endless game, a game where the survival of the board itself is the ultimate prize. The historical precedent, when debt was actually debt. To truly grasp how radical our current system is, we need to understand what debt looked like when it was, in fact, a repayable obligation to a specific entity. Go back to the 19th century, the era of the Rothschilds and the Barings. These were private banking families who lent real capital, gold and silver, to nation-states. When Britain fought the Napoleonic Wars, it didn't turn to its own central bank to create money. It went to Nathan Rothschild. The terms were clear, the risk was real, and the expectation of repayment in specie was absolute. The creditor was a person with a name and a balance sheet, and default had immediate, severe consequences. This was debt, with a human face and a clear deadline. The modern template for managing, rather than repaying sovereign debt, was forged in the aftermath of World War II. Britain emerged from the war victorious, but financially ruined, with debt exceeding 250% of its GDP, a level similar to Japan's today. The government made a conscious decision. They would not attempt to pay down the debt through punitive austerity, which would have crushed the recovering economy. Instead, they focused on growing the economy faster than the debt grew. They allowed moderate inflation to gently erode the real value of the debt over decades. It was a policy of slow-motion default, a recognition that the debt was too large to be settled, only managed. The critical turning point, however, came in the 1970s with the final collapse of the Bretton Woods system. Dollars last linked to gold in 1971, it unleashed the era of pure fiat money. Currency was no longer a claim on a physical commodity, it was simply a government promise. This was the birth of the debt system we know today. It allowed debt to become completely unmoored from any tangible constraint. Governments could now issue bonds that were ultimately backed by their central bank's ability to create infinite currency. This was the final step in a historical pattern. From the Roman Empire debasing its silver denarius to fund its legions, to medieval kings clipping the edges of gold coins, rulers have always sought to manipulate the monetary system to avoid the hard choices of taxation or fiscal restraint. The modern system is simply the most sophisticated, globalized, and institutionalized version of this ancient practice. The key difference is one of scale and denial. What was once an emergency measure reserved for times of war or existential crisis has become the permanent, everyday operating system for the entire global economy. We have systemized the ancient art of debasement, dressing it in the complex language of quantitative easing and bond yields, but the fundamental mechanism of creating claims that can never be truly settled remains the same. How the system sustains itself. But a machine this vast needs more than just willing participants. It requires fundamental forces to keep it running. The first is compound interest. The system is designed so that the debt must grow faster than the underlying economy that supports it. It's a mathematical inevitability. When you have a massive existing debt pile, even low interest rates generate enormous interest payments. To make those payments, governments must borrow more, adding to the principal, which then accrues more interest. It's a treadmill that accelerates on its own. This is where the system's safety valves engage. The primary mechanism for managing this unsustainable growth is inflation. A steady, moderate rate of inflation is not an accident. It is a policy goal. Why? Because it acts as a silent, universal default. If you owe $100,000 and inflation runs at 5% per year, the real value of that debt shrinks over time, even if the number on paper stays the same. Your salary might nominally rise with inflation, but the fixed debt becomes easier to manage. It's a subtle transfer of wealth from savers, who see their cash lose value, to debtors, who see their obligations melt away. Similarly, currency devaluation achieves the same result on an international scale. A weaker currency makes a country's exports cheaper, but it also makes its foreign-denominated debt cheaper to service. It's another way of reducing the real burden without ever writing down the principal. This entire edifice is held together by a regulatory framework that forces compliance. International banking rules, like the Basel regulations, designate government bonds as risk-free assets. This forces banks, insurance companies, and pension funds to gorge on sovereign debt to meet their capital requirements. They are not making a choice. They are obeying the rules of the game. This creates a captive, perpetual demand that ensures there is always a buyer. The final, most fragile component is psychological, the exorbitant privilege of reserve currency status. $, is the keystone holding up the entire arch. Debt evaporates, and the system seizes. The inevitable conclusion is that this is not a system designed for repayment. It is a system designed for control. Control over interest rates, control over economic activity, and control achieved through the perpetual creation and management of obligations that can never be settled. The goal is not to zero out the ledger. The goal is to ensure the ledger grows in a controlled manner, forever. The human cost and coming reckoning. So we arrive at the human cost of this perpetual motion machine. The system operates through a silent transfer of wealth known as financial repression. Savers and wage earners are systematically robbed through inflation and artificially low interest rates, their purchasing power funneled to the state and the financial institutions that manage the debt. This erodes the middle class, fuels inequality, and breeds the political instability and populist anger we see today. People feel the system is rigged because, in this specific sense, it is. The historical warning is clear. All systems built on such mathematical impossibilities eventually reach their limit. The reckoning arrives not when the debt is called, but when confidence in the managers of the debt finally shatters. The final, unsettling truth is this: we are not in debt to someone. We are all trapped inside something, a machine whose survival depends on our perpetual participation. If this perspective on the hidden architecture of power resonated with you, please support our channel with a like and subscribe to Finance Rewind for more critical analysis that cuts through the noise.